कैश हर खुशी के लिए काफी है। Co-presented by Coin DCX, your gateway to crypto. Co-powered by Green Lamb Laminates, हर गुस्ताखी साफ।
Hello and welcome to the Business Today show. I'm Udayan Mukherjee. My guest today is a true doyen of the Indian financial sector. To him goes the credit of creating India's largest private sector bank. But not just that, he then went on to become or serve as chairman of one of India's leading technology companies. And now the government has given him the task of reviving infrastructure development in the country as chairman of the National Bank for Financing Infrastructure and Development. You would have guessed, my guest is none other than the legendary KV Kamath. Mr. Kamath, pleasure having you on the show and great to see you again.
Thank you, Diane. Likewise.
As I said in my introduction, you've worn so many hats in your life. I mean, of course, ICICI Bank is the big one, but then chairmanship of Infosys, the National Development Bank, and now as the chairperson of NaBFID. I mean, these are very disparate and diverse kind of responsibilities you have undertaken in a very checkered career. But which of these stints have you really enjoyed the most?
Well, I think enjoyed is too narrow a term. I would also add challenging and, gave you a sense of contentment and enjoyment. So I would think three things. Infosys was different because it was an established company with a great history of leadership. So I was in a transitionary position there. If I look at NaBFID, which we can talk about later because it's still in startup mode, then it's really between ICICI and the New Development Bank or the BRICS Bank. ICICI was, again, right in the midst of a challenge in the 1990s, going on to dream something and, maybe make your dream come true. Dream was initially of survival and then building things. I think was a much bigger challenge than NaBFID. Much bigger challenge than NDB. NDB, the interesting part was that you had to work with 5 cultures and learn how things get done in a different context and execute it. But overall, I think ICICI probably, if I look at on that the frame with 3 reference points, ICICI would have been the most challenging, most fulfilling in a way, and learning, I would think, from a learning point of view, also the most. Thank you.
Yeah, it doesn't surprise me that you say ICICI. I mean, you almost single-handedly brought that bank up to where it was. But having done that, I mean, it's been quite a few years since you stepped off the MD's chair there. Do you still keep tabs on how your old bank is doing?
I keep tabs on everything that is happening around. Your last question, I think, is going to be, what are my other interests? My interests are trying to understand what happens around me. And that includes in every space, whether it is the IT space, whether it's the technology, the new technology, old banks, that indeed would mean ICICI Bank also. So I look at working results of all banks, try to understand what's happening, just to educate myself. Nothing from the point of view of talking to the bank and giving them feedback. If at all I have feedback to any of my relationship with as a customer, and not as anything in the past. But yes, I look at all banks, I look at performance, and I see what is happening so that I'm wiser.
Well, back in your day, I mean, there was this intense competition between the trinity, as we like to call it, the trinity of private sector banks. There was ICICI, there was HDFC Bank, and there was Kotak Mahindra Bank. And not much has changed today. I mean, HDFC Bank seemed to have been ahead over the last many years. But over the last couple of years, you would have noticed that people are talking more about ICICI Bank stealing a march over HDFC Bank. In your day, how did you see the competition between the three? And how do you see the three of them positioned today in the marketplace?
I think, actually, if you look at the period 96 to maybe the mid-2000s, so 2006, 2007, the ICICI Bank was clearly ahead in a lot of things. Again, we had to probably do things because of a theory of constraint. We were constrained by capital, so you jump higher, you raise money in first the GDR market and then the ADR market. And then the bank follows suit. For survival, you need to diversify and recast your strategy and become a retail institution. That is, I'm talking of ICICI, and you see the bank as a vehicle and you merge the two. So we have had to do things because constraints came in our way, challenges came in our way, and we jumped. And in jumping, we set up new things. Similarly, roll out of ATMs. There were 30 ATMs in the country. We said, let's roll out 1,000 ATMs because you're not going to get branches. We're getting 50 branches a year. And the number one bank then had 10,000 branches. It would have taken us 200 years. So we adopted technology strategy. And then, getting into retail also was portfolio diversification. So in those days, we built all those things. And we didn't have the luxury of CIBIL. So we had to build the book in a hard way. And thereafter, I think from 2005 or 2006 onwards, we started getting CIBIL scores and things became easier. And I think the competitive reference changed. So I would think most part of my leading ICICI, it was like a lonely journey. Lonely because a lot of things you did because you had to survive and you had to grow. And of course, there were then competitors said, but honestly, at that point in time, our thought was more on building a strong foundation for the bank rather than competition. The competition came later on, yes.
And what about today? Would you say that ICICI Bank is ahead, or do you think the other two competitors are equal stalwarts?
Let us look at three reference points for any institution, not only a bank, not only financial services business, but any. We are talking of financial capital, human capital, and technology capital. And then it is all enveloped by governance and leadership. So if you look at the first three, they are all today available in the marketplace. And today, all banks are properly capitalized, clean balance sheets. Human capital, I think, given 20 years of or more of being in business for these banks, again, you had a scope to build up capital, human capital as well. And technology has been changing rapidly, but is available. Yes, I think in all institutions, and I'm not talking of these three, across any institution, there is a hubris. And with time, even in technology use, there is hubris. And then there's also the fear of change of technology. Do I want to change? So that makes changes in terms of how you look at your path forward. And we will talk about later on the digital startups. So those will have a lead on the incumbents in that field. So I think in terms of the core requirements for driving a business, all banks are the same. I think they have a leadership plate which also has been tried and tested. I think it is now each leader's way of doing things, the current leadership, which will determine the future of these banks. But then, I don't think there is, in my mind, competition in the Indian context. There is only one word: opportunity. Because if you look at India 25 years down the line, and I always use 10% as my aspirational growth, and you have a 10% doubling every 7.2 years. In 25 years, you will double from 3 trillion to 6 trillion to 12 trillion to 24 trillion as the size of the economy. So where is competition in this size of the economy? You will need institutions of a much higher order, many more of them to drive this. And I think I cheer and will wish every one of these and more who come into the field great success. Because that's what India needs.
Now your focus is different. Well, not quite different, because you are no stranger to financing infrastructure. But the core thrust is infrastructure. And on that, India has slipped a bit. I mean, in 2007-8, the period that you were talking about, our capital formation had gone up to a really respectable level in the high 30s. From then, it's been downhill. I guess part of your job is ties in with bringing capital formation up to very respectable levels again. So before I ask you about NaBFID, a macro question on whether you think we are at a stage where capital formation can take off again after a decade of being in a bit of a slump.
I will answer it this way. There is no other choice. There is no other choice. And in a way, I put the reference context before this, assuming a 10% aspirational growth and hitting a 25 trillion economy. So you have to invest. There is no choice. Now, how will that investment is, I think, the question really that you are asking. And that will happen through a combination of ways. I think ultimately, everyone expects the private sector to be the engine of investment. in the infrastructure side, for a variety of reasons, I think it'll take us a long time. Post the 2008, I would say, a high as it were, then investment has been challenged. It has not, and as a consequence, we see a slump. But even that, the challenges of that, whatever happened, then, I think have been now addressed. And it was like a perfect storm that happened during the period 2010. And so that has been addressed in terms of. Now, I think the government very correctly decided that if indeed this challenge is there, and on the one hand, balance sheets were being cleaned up, it's corporate, balance sheet, banks were being cleaned up, we need to invest. I think the government did a great thing by basically saying that infrastructure we will do in innovative ways, either through SPVs or now basically they're saying what we have on the books will demonetize, create cash flow and go along. I think this is the way that things will happen. And then I would think when the private sector is comfortable, that growth is here to stay, things are stable, and as usual, they will pile it. So this is on the infrastructure side. One sentence on the other side, the manufacturing on the other side. But then looking at the ICICI or the State Bank or any other banking institutions which are major corporate lenders going back 15 years, and today, our clients of then, who used to all leverage themselves, in the year 2000, the leverage was 4:1. 2009, it was around 2.2:1. Today, they are all deleveraged. They have virtually no debt on the books. So when they find that the demand-supply equation is something that they want to now invest, dictates that they invest, they're going to invest at speed. There's one major difference between then and now. Say even 10 years back, it took us 3 years or so to actually get a project up. I think today, most projects can be gotten up in 12 to 15 months. So the lag or the lead time that you require is much shorter. So companies will come in to invest very quickly.
Now, let me turn to NaBFID for a second. You used an interesting term to describe it, startup. I mean, for an organization which is aiming to have a 5 lakh crore balance sheet in 3 years' time, startup seems a very small kind of a phrase to use. But tell me, Mr. Kamath, I mean, where are you with rolling out the loans with NaBFID? I mean, by when will things start, or have they started already? I mean, have you started the process of financing already?
Well, then I think I will stay on startup for a moment. Startup is a very apt phrase. Throughout my 5 years at NDB, the BRICS Bank, I use the word startup. And some of my colleagues were worried. Let's say you go to a rating agency and say you're a startup, they will not understand it or they will misunderstand it. I said, no. I think what advantages a startup gives you, a light-headedness of mind, the ability to move, be agile and so on. If you say that I'm an established player, you will never get that. So I would like to believe that, at least in the initial phase, it was a startup. Now, to answer your questions, we spent the last 6-7 months in getting a very small core team, 25 to 30 people in, getting all the policies done. So every single thing is done, creating a pipeline. We had people, wonderful people, leaders from both the public sector and the private sector who helped us in all these areas. So there's a substantial pipeline of almost 65,000 crores, which has been identified. As of yesterday or day before yesterday, we have a CEO who's been appointed, who should hopefully join in the next few days. So the first part is met, and we have 3 other positions on the board, deputy managing directors, who I think will be on board in the next 2 weeks, because the final stages are on, the bureau is fully active on this and so on. So given that, we went as far as a board could do in a governance context. We can't lend, we can't do certain things and so on. So I think everything is ready for the CEO and the executive team to push. As I said, the project identification has been done. Quickly the appraisal and the putting on the board. Now, funding side, I think we have time because the government was very prompt in giving us the capital and the grant that they had to give. So by February end, we had both capital and grant that has come in. Leveraging it, I think, is not a hurry at this point in time because we have the purpose to start spending. And I would like a few quarters balance sheet and P&L to come. The first quarter has come out, the second quarter should be coming out anytime now. And thereafter, we get into the mindset of quarterly numbers out very quickly into the quarter. Then you go to the market to raise bonds and money. So I think by the last quarter or the first quarter of the new calendar, we should be ready with our borrowing plan. But before that, I hope the new team is, could get the projects going. So I think we will be there this year. I think we're not talking of later, but I think that the appropriate person for next week is going to be the CEO to set his agenda. But the preparatory thing in terms of getting the institution off the ground is done. And I must thank the government for not only bringing in the capital, for support to all the phase of this, getting to this point that we are in, which facilitated very quick out. And then I would think, the monetization plan that has been announced by the government is a wonderful add-on to whatever we might want to do, because that also opens up opportunities. And it not only opens up opportunities for NaBFID, it also opens up opportunities and ideas for the private sector players, how to shed assets and how to then reinvest.
This is an interesting point, Mr. Kamath, because, since the announcement of the asset monetization plan, a lot of private sector players, CEOs, have been waiting to see how quickly things will move. Would you agree that the monetization plan actually, in brass tacks, has actually not moved at the pace at which it might have moved? I mean, how soon will we see these assets being offloaded to private players?
I think my view is identifying the asset was the first task which has been done. I think the second task is to see how many of these or what's the amount in each sector which can be quickly created into a structure. Then the challenge would have been if there is no structure available. The structure is already there. And there are two government entities there which have taken the lead in creating the InvIT structure, which could be the ideal structure for monetization. I would think that would be probably the most ideal structure. There could be other structures of the people bidding and taking it on and so on. You already have an NHAI InvIT and you want the power grid InvIT. And then there are, I think, a couple of private sector InvITs in infrastructure and in a whole lot of other areas. So it is not as if that one is getting into through the monetization process. InvIT is where asset will land. I think the structure is ready. And I know that the regulator is on top of this, trying to see how the whole process could be facilitated. So once, I think, post-identification, actually narrowing down to getting the asset on the table happens, I would think give it a quarter, it should move.
Time for a quick break, but we shall return on the Business Today show with KV Kamath. Don't go away.
Tensions are rising between China and Taiwan. Since Nancy Pelosi's visit to the island, China has broken into Taiwan airspace more than 20 times. If a war is unleashed, Taiwan is likely to fall short against China. Here's a look into China's 5 most powerful weapons that can set the tone if there is a war. Number 1 is China's hypersonic glide missile. This is a DF-Z7 model. It is a precision strike weapon. It is capable of delivering nuclear weapons. This weapon can be fitted to various Chinese ballistic missiles. AG-600 is the world's largest seaplane. It can operate on ground and water. It is 129 feet long and has a wingspan of 127.3 feet. The seaplane's speed is 500,000 per hour and its range is 4,500 kilometers. China has 15 of these landing ships. They are amphibious in nature. They can carry up to 30 attack helicopters per dock. Its length is 778 feet and the beam is 118 feet. There is not much information on the stealth bomber, but it has a range of 8,500 kilometers. It is nuclear capable and can threaten US targets. This weapon is said to be under development. Golden Eagle is an unmanned airship. Since China has a lack of pilots, this breaks their way. It can fly at a speed of 100 kilometers per hour. It can stay in the air for up to 6 hours. Its length is 50 feet and the height is 16.
Welcome back. You're watching the Business Today show. I've been in conversation with KV Kamath, the former CEO of ICICI Bank and the current chairman of NaBFID. Now, we spoke about many possibilities of how things might really start revving up in the next 18 to 24 months. But, that is also the time where fair degree of doom and gloom is predicted in the Western world. I mean, people are talking about recession in Europe and the US. Inflation has been a problem, of course. Now, how do you see us negotiating all of this? The global slowdown, the lack of liquidity or less liquidity in the global system. Do you think they might come in the way of the fleshing out of the cycle that you and I have been discussing over the last few minutes?
If we were having this chat 2 years back, all things being same, I would have said, yes, it's a big challenge. But I believe that the current inflation in India and the current inflation in the West is of an order that is something that probably in a theoretical construct has nothing to do with what we were taught of inflation. Because otherwise, could you really imagine that you have inflation of over almost double digits in Europe and the real interest rates are probably just about 0.5%. So how do you explain this? And interest rates are 0.5%, real interest rates are minus 9.5%. And slightly different in the US. And nobody seems to be worried, starting with the central bankers there. Now, I'm saying that whether it is, and in the US, you have a situation where inflation is at those numbers, 8% plus. You have a full employment, not seen in the last 40 years. And you are probably seeing in recessionary numbers, and nobody wants to call a recession. So we are learning. So we have to, all I'm trying to say is, now we will have to dance to our own music. We cannot dance to Western music. And that is where I would commend the government for keeping interest rates low. But my question would have been, if interest rates have been hiked, how would hiking interest rates bring down price of tomato? Because that was the key item of which inflated the agricultural thing. So things are different, and by keeping interest rates low, liquidity good, I think we have come out of the crisis, along with certain other facilitators, the digital push and so on. But let me not confuse the matter. So given that, I think we will have to draw up our own map of how we grow. And to me, that map is have enough investment that has to be done, because we've got a 25-year runway. The West doesn't have that. And we have been anyway predominantly a domestic funded country. We will have to continue to rely on that. The good news then is that 3 to 5 years back, corporates were not generating enough cash flow to grow. Today they are. If at all they want funding, it's only at the margin. It is not the bulk of it. It is at the margin. So I think the India we're looking at today is an India which is completely different in how and where demand comes for what it produces, its ability to implement projects, and its ability to probably fund projects also. And of course, along with the technology envelope that goes around.
Right. Finally, let me ask you, Mr. Kamath, I mean, you've spent such a long and checkered career in the financial sector. Who are the people you really respect and admire? Because you must have brushed shoulders, competed with some of the real big names who created great institutions in their time as well. Who are the people who stand out for you?
Yeah, let me put it this way. I think as we built our business, we learned from everybody. So we learned what, say, DFC was doing. So Deepak Parekh would be somebody we admire. Then you looked at competition on either side. When there were global banks which were doing some retail business, you learned and you picked up things from them and you went along. For example, the ATM strategy that we rolled out, the 1,000 ATMs, the initial small number, 50 or so, we had heard that Citibank wanted to roll out, and then we heard that they succeeded. But for whatever reason, they didn't scale up. We went ahead and scaled up. So you looked by learning around from you. But I would think that in the context of what we had to do and the technology that we brought in, we had to look around us, beyond the financial services business, to learn. And all this also needed, I would think, a great degree of trust that technology would work. And there, frankly, it was only Moore's law that the cost of technology will keep dropping at its pair. And computing power will grow at a square. As long as your client base doesn't grow at that pace, you're okay. So we went ahead and implemented things using that strategy, and it worked.
It's wonderful hearing all this, Mr. Kamath, from you, and I wish you all the best with NaBFID, your new startup made growth from strength to strength. Congratulations on a spectacular career, and my great thanks for joining in today.
Thank you, then. Bye-bye.
Black holes. Did you ever worry that Earth could get sucked into one of them? Black holes do have a massive gravitational pull that allows it to swallow anything that gets in its way. Let's find out more about them. Black holes have been lurking in the galaxies for billions of years. The most powerful known forces in the universe, their gravitational field is so strong that nothing, not even light, can escape from them. They're actually packed full of space matter, so they're not really holes. There are at least two types of black holes. Stellar mass black holes form when a huge star, more than 10 times bigger than our Sun, burns up all its fuel and collapses in on itself. Scientists say there could be billions in our galaxy, the Milky Way alone. They grow by gobbling up other stars or merging with other black holes to become a supermassive black hole, millions to billions of times bigger than the Sun. Humans can't even see black holes, but we can observe their effect on matter close by. When normal stars are sucked in, they accelerate and heat up, emitting X-rays which are detected by orbiting space telescopes.
Make your media plan smarter with India Today Live TV on your connected devices. Everyone's busy finding what's trending. You're busy finding out why. India Today, for those who research before reacting. Download the India Today app now.